All right, good morning. This is Bakes, Kevin Baker, Bakes Takes. Welcome to the podcast. It's Tuesday, 9/21, and this is a special edition and audition with an E and an A. Tim Rotolo, the CEO of North Shore Indices, is my guest. They run the uranium trust that I talk about ad infinitum, URNM. And Tim, welcome to the show. Great to have you on.
Thanks for having me. Glad we could finally connect, and good timing with everything that's happening in the sector.
It's unbelievable. A heck of a couple of weeks. I know some of this, not all of this, but for our audience, please tell us about your path, how you found URNM, or how it found you, maybe.
Yeah, that's probably a better way of thinking about it. So I spent a couple of years at Merrill Lynch on the private banking side. So we were basically global asset allocators. Started doing some fund investing there. We had kind of like an endowment style portfolio model, and got really interested in what hedge funds were doing, and found that they were looking at these really interesting either niche or distressed things, and wanted to get closer to capital allocation. And so I in 2009, great timing, joined a credit and distressed hedge fund funds, and got a lot of exposure to some of the best investors in the world, guys like Paul Singer at Elliott and David Tepper at Appaloosa, Dan Loeb, and this idea of kind of really fundamental value investing with an event overlay became kind of my preferred style of investing. And I think increasingly I was realizing that broad markets are pretty efficient, but there are these pockets of inefficiency, and they tend to be in these smaller markets where really bigger players can't participate. And I spent some of my time gravitating towards those types of opportunities at that firm, and in 2015 decided that I actually wanted to spin out on my own and try and find those types of ideas myself and deploy capital directly to them, either through a manager or ultimately, making the investments myself. And then so I did a few things along those lines. Looked at some things in the cannabis space. Launched a small company called Architis Ventures with a couple of guys out of LA. We launched a equipment financing business that ultimately went public. It's called Extraction, or now it's called XF Financial. Trades up in Canada. Really cool little sector. So when we looked at in cannabis in 2017, it was pretty inefficient. There was not a lot of capital. They were just starting to have companies go public, and I think it got a little bit ahead of itself. And you're still seeing kind of reverberations of a lot of capital being allocated to this sector, probably inappropriately. But now there's starting to be some emergence of opportunities. And so fast forward to late 2017, I'm on Twitter of all places. And so I'll take one step back. At one point in my prior role at Sandalwood Securities, we had been asked by a guy up in Boston to create a Boston only hedge fund manager fund of funds. And one of the managers that we went to meet with was Jeff Vinnick. And Jeff was in the process of hiring a guy called David Iben. And David was going to run a deep value part of his portfolio. And then Jeff's existing team was going to run a GARP style, and they were going to kind of combine forces. And it just so happened that was in 2012. And David Iben's favorite idea at that point was uranium. So he had a big position in Cameco, a big position in Denison and Fission. And so I started to look at it back then, and fast forward to 2017, I look at David Iben's portfolio, and he still owns those stocks. But so I'm on Twitter at one point, and I see this guy. I think his handle was deep value stocks or something like that.
Okay.
And he's talking about uranium. I'm like, oh wow, is David Iben on Twitter? And he happened to have his DMs open, so I sent him a DM, and he said, no, I'm Mike Alkin, and I just wrote this white paper. And I said, oh, that's so interesting. Send it to me. And so I read it, and it just so happened that Mike lives just a couple towns over from me. and we had a mutual acquaintance. And so we all got together for lunch and talked uranium, and, ended up launching a fund, which is Sachem Cove Partners, which is the firm that Mike is CIO of, and I help run the business there. And we got really deep into uranium, and it just was such a fascinating sector. And really, it was at the intersection of all of these things that I thought made, a very attractive investment opportunity. Highly capital constrained because all the money had gone away post Fukushima. It was incredibly inefficient because you had no sell side and too small of a market cap to be able to attract generalist hedge fund investors to make it more inefficient. There was no sell side. There's just a myriad of things that on its face, without even kind of understanding the depth of the fundamentals that Mike did at that point, I was immediately attracted. And so, we ended up launching Sachem Cove. And then as we kind of got further into the sector in 2018, we saw this news about URA changing their mandate. And I just looked at it and said, oh man, well, first of all, what a fascinating bottom signal this is. You have kind of the only player out there going about as far as they can without shutting down their fund, which is a phenomenal contrarian signal. You look at Van Eck shutting down KOL last year, and look at what Cole's done this year, on absolute fire.
Couldn't agree more.
Yeah. So I loved just that contrarian signal of these guys changing their mandate when the fundamentals of the sector were arguably, the most attractive they've been. And so they created this, further negative feedback loop within the sector and really pushed the prices of the equities down. And I looked at it, I've always been very entrepreneurial and, curious. And so I said to myself, if we're right about this thesis, which I had absolute conviction, I had the majority of my net worth invested in the stocks, and very much aligned with our investors in the hedge fund. And I said, if we're right about this sector to the magnitude that I think we are, there's going to be a space for an ETF. And I looked at things like LIT and, some of the other kind of niche commodity ETFs where the commodity story wasn't even that attractive. And these ETFs had hundreds of millions of dollars. And so at that point, I think URA had something like 300 or 400 million. And, at the peak, the market cap of the uranium sector was about 150 billion. I felt like if we could capture a 0.5% or 1%, that's a pretty great product. And I actually had to fight the board when I ultimately went to launch the ETF about the idea that there's sufficient liquidity in market cap. And I said, you can't look at what the market is today. You need to look at where it's going, and that liquidity will come back, market cap will come back, new names will be added to the sector. And, thankfully that's actually worked out. And we've had a lot of liquidity come back. And so it took us some time to figure out the back end mechanics of how you actually launch an ETF, which is, a topic for another day, but, fascinating path there of, so building the index, trying to build an index that was sufficiently different from what existed, and taking a lot of the things that I had learned at the fund of funds about portfolio construction and really trying to apply those so that we would get, kind of maximum asymmetry. And so that's kind of how we came up with this idea of having about 80% in the minors and 20% in the physical. I felt like the physical provided a really nice ballast. It's going to give you that one-to-one correlation, but it's going to also act as a downside buffer if things go bad. And then we had kind of a very capped, when we always looked at the sector, as kind of the hedge fund, it was clear that the big producers were not where the torque was, right? You weren't going to make the most money in Cameco or Kazatomprom, but you still should own them because they're high quality producing companies. Cool. And so that's why we wanted to limit. And so again, we looked at, what Solactive had done for the index that URA used, and they had very large positions in those companies. We felt like they were outsized and they were limiting the ability to generate those really asymmetric returns if the sector did move how we thought it could. And so that's how we ultimately constructed the index. And I think we just got really fortunate in some ways that we launched in late 2019, so December 2019.
Well, let's talk about that, because I asked Mike to pull up my chart here, which I'm just drawing different lines on the same. This is the weekly of URNM, and you must have said, okay, now I finally went through the ETF process, and then COVID hits, and your uranium goes from 30 to 18 in an afternoon. It probably felt like. Give me a thought process at that point in time, and your conviction in the thesis.
Tested. Yeah, I mean, any volatility like that's terrifying. I mean, that was. I don't think people appreciate how violent that move was for everybody, right? Stocks down 30% in just a straight line is not fun. When I should go back and look at the text message, but that night when the Fed came out and announced their plan, I sent a bunch of text messages, not about uranium, but just saying, it's on. Like, this is the bottom right here. And, I didn't have a lot of capital available to deploy, but I definitely told people that, uranium was a very interesting and more attractive opportunity, particularly as more supply came out of the market, right? When you start to see the Kazakhs shutting mines and having to curtail production because they couldn't get people out to the mines, it became apparent that this was potentially a very positive development for the supply side. And, nuclear power is not going to shut down because of COVID, right? So you had kind of this great dynamic. I don't think I appreciated kind of how positive it could have been, but it certainly jump-started or further built on the supply deficit story. And you saw that in the price of uranium. Which went from basically the mid-20s to the mid-30s, and it pulled back from there. Once Cigar Lake was restarted, and but I think
tell our viewers what Cigar Lake is for those that
Cameco closed down. So they'd already shut down McArthur River, and they ended up closing Cigar in order for really due to COVID reasons. And because, just more production issues, but it was a meaningful event for the sector. And then I think when it came back online, even though it took longer for them to bring it back online than people expected, but when it came back, I think the market kind of looked at it and said, oh, there's all this new supply. So again, one of the most fascinating things about this whole uranium market is how disconnected sometimes the market is from what you would think are consensus expectations. You can drive a truck through kind of what the market thinks or consensus is versus, I think what smart people actually interpret. And that creates a lot of alpha opportunities for people who are doing active management. And it is a sector that probably lends itself very well to active management. But the complexity, the fact that it trades, 60% of the names in URNM trade in the US, about 20 or 30% trade in Australia, another 20% trade in London. It's a really global market. And so in order to efficiently access it as a retail investor or small time investor, it is challenging. And so the ETF provides, a very effective, efficient way to put capital to work across all of those markets.
Yeah, that's exactly what I saw back in July of 2020. And frankly, back then, I didn't know uranium from a 2x4, but I can read a chart. And I said, something's going on there. And then I went into the weeds, and I think I got you on the phone right around that point in time. And I said, this is for real. And it's about the best risk reward I've seen. I've got my arrows here. We're in at around 30. And I'd like to put this out there as some perspective, especially given what happened yesterday, that, frankly, the stocks moved ahead of the spot, which is what you usually see. and then we doubled in the last month. I was even surprised by that, looking back at it. And then we pulled back to 79 yesterday, a level that I mentioned on the show that we're going to be putting out today. But I want to have that perspective for everybody that, people saw it down 15% at one point, and they were kind of tweeting me and texting me like crazy. And then I want to show this chart to say, let's have some perspective here as to the long-term viability of this. I'm going to segue to that, where I was with my dad yesterday, and he asked me, why is uranium going up so much and now, and where is it mined? So if you could point to that a little bit, I'd appreciate it.
Yeah, I'll talk about just kind of the fundamentals and where uranium comes from. I mean, so you have there's several primary places so the Kazakhstan has 40-ish% market share. That the way that we have exposure there is through Kazatomprom, but they have some JVs with other folks like CGN Mining and Cameco. Kind of the highest grade mines in the world are in the Athabasca in Canada. So that's Cameco and NextGen, Denison. So that's kind of the hotbed. Those are the two big primary producers. And really there's some production in Australia. There's some potential future production in Africa, and actually there's again the jurisdictional diversification of the fund is also interesting because a lot of people shy away from Africa because of the headline risk. We thought it was important to give people exposure to those stocks because candidly, I mean, they have tremendous upside, and there's some really interesting assets like Paladin, like Lotus, which actually Paladin effectively spun out or sold to a company that turned into Lotus. And so we think it's important to have diversification across those various jurisdictions. There is some planned production in the U.S., but very minimal today. But we do have some exposure to companies in the ETF that are U.S. based. Uranium Energy Corp, Energy Fuels, Encore Energy, which has been kind of a big winner for the sector. So try and provide diverse exposure and not make a big bet on one part of the world.
And talk to me about your rebalance quarterly. I have that right?
Actually, we've updated our methodology, so now we rebalance semi-annually. And again, that's just something, a learning process. We'd started quarterly, and because the sector is fairly illiquid, the rebalances can create some real volatility. And so we didn't want to be rebalancing when any of the other ETFs were. So we chose to just change that to semi-annual. We've made some other probably less obvious changes around the rebalance. We actually set the rebalance date a little bit earlier in the month, so that the percentages are actually determined earlier in the month, which gives our portfolio management team more time to actually do the rebalance. So it's not this end of the month, last day rush that creates insane volatility. So we're having watched what happened with some of the competitor ETFs, who in my opinion have kind of done more harm than good in certain instances. We wanted to make sure that we were really acting as fiduciaries, but also as in the best interest of the shareholders and the sector as a whole.
Yeah.
And try and make sure that there was not unnecessary volatility that was disrupting the whole sector.
You're not going to tweet out your buy list the way URA did. In essence,
there's certain dynamics that's just so active. That's what they do.
Yeah. Okay.
So no, we are a little bit more guarded about some of that information. But people are going to front run ETFs, right? There's a lot of smart people trying to figure out what's going to go into the ETFs. given the size of some of these companies, particularly the newer entrants, I don't think it makes sense for us to publicly disclose who those are going to be.
Could not agree more. Why the number is 82.5% miners, 17.5% physical uranium? Why those quirky numbers?
Sure. So the simple issue or answer, is SEC diversification rules. So effectively, you can't have more than 5 issuers with greater than 5% position be more than 50% of the portfolio. So in order to keep ourselves under that cap,
gotcha,
and have Cameco and Kazatomprom capped at 15, we needed to have those levels. And actually, you see there's kind of another quirky, it looks arbitrary, but it's a function of the diversification rules. The next cap, so the largest positions are capped at 15%. And then below that, it's 4.7. So some people will say, why not 5? Well, because we need to keep those positions under 5%.
Okay.
Now, we have gotten some questions recently because we've drifted above those levels. The way that rule works, the SEC, the RIC diversification rule, is that it's based on the quarter. So if at each quarter, when we report those numbers, our numbers are above 50, we would have to rebalance. But intra-quarter, they can float above 50.
Gotcha. As you and Michael, or what does he prefer, Mike or Michael?
Yeah.
Okay. How much market cap right now? I know you said it's going to expand, but right now, the market cap available for you to invest in is what in uranium right now?
35-ish billion.
Okay.
Yeah. But keep in mind, Cameco is 9 billion. Kazatomprom is about the same. So it's a very top-heavy industry.
Yep. And then what drove me to you was that you were the pure play. But please elaborate on tilted to junior miners and how that differentiates you from your competitors.
Yeah. So at the highest level, we have those 15% position caps on Cameco and Kazatomprom. If you look at some of our competitors' indices, they have much larger positions in those, 20% plus. And so that obviously, any dollar that you give to those guys, you can't give to a smaller miner. And so we wanted to just ensure that those larger producers were not so outsized as to dominate the performance of the portfolio.
Gotcha.
And we also just tried as early as possible. So again, some of this stuff isn't relevant today, but we had some non-pure play miners in the portfolio. The second there was sufficient liquidity in the sector, we punted those and we took that. I think it was about 1,000 basis points, so 10% of the portfolio that was non-pure play, and we reallocated that towards junior, the smaller miners, where we think there was more torque and more upside appreciation opportunity. So we will continue to do that. I think that process is kind of done, but on an aggregate basis, if you look at our portfolio versus our competitors, we just have more exposure to kind of the developers and near-term producers in the sector than they do.
What changes to the original? In your materials, you talk about green energy, supply deficit, growing demand. What changes have happened to the original thesis where there's been positive surprises or negative surprises, please?
I can't really think of any negative surprises. I think there's been a lot of upside kind of right tail demand creation that we hadn't expected. So ESG was kind of in its infancy when we started to think about this.
Okay.
It certainly was not relevant to nuclear. That battle is still being fought. But I do think that there is an increased awareness of nuclear's role in decarbonization. And so that's been very positive. And just that I think more eyeballs are looking at nuclear power and thereby uranium because of ESG and because of the pronouncements from China, Japan, Europe, the U.S. all setting these carbon neutral goals out in the relatively near future on a relative basis, for that type of transition of an economy towards a new energy source. I think, we can talk about kind of near term or more recent performance. But if you go back to, I think, November or December of last year, there was a huge bump in performance. And some of that, I think, was the realization. I think there's a B of A piece that came out and said, if some of these nuclear reactors in the US get saved, well, that's like 20 million pounds a year of demand that the market is not pricing in. And so I think the political winds changed favorably in that nuclear became this bipartisan issue. And so again, like even in the last 2 weeks, you saw Byron and Dresden saved in Illinois. And so that's a meaningful amount of demand that the market didn't think was going to be there, and has now been saved. Depends on your position about bailouts of utilities or not letting free markets work, but that's a very meaningful event for nuclear, and particularly around sentiment for nuclear, that wow, maybe we actually do have the political will to save some of these reactors, because the best investment that the US can make as the largest user of nuclear power is actually extending the life of these reactors. And so you're seeing that globally.
Yep.
Is that, and so again, as the political winds change, now there's some discussion that even Germany might go back on their pledge to shut down all their nukes. Again, I'm not saying that's going to happen, but that's a big right tail risk. The Chinese came out and accelerated the growth of their nuclear fleet. Again, market not necessarily pricing that in. It's priced, I would say it's probably priced in now. But when it happened, I think expectations have been so low around nuclear power that there was an opportunity for these upside surprises. And then, that doesn't factor in things like small modular reactors, which are gaining, a lot of notoriety right now as a potential, maybe too much because the technology remains unproven, but out a few decades, that's another potential source of new demand. So all of a sudden, you have this very beaten down story kind of getting these positive tailwinds. And so those are always the things that you like to see is, these events that no one kind of appreciated, and you knew were mispriced, but you didn't need them to happen for the thesis to play out.
Right. And
that was kind of always the starting point was, you have a supply deficit that's formed, nuclear power is growing, and as long as nothing catastrophic happens, there will remain a supply deficit out for several years that can only be filled with higher prices. Now, if we want to talk about kind of maybe the biggest upside surprise, it's Sprott, right?
Are you reading my notes? That's exactly where I was going to go. Yeah.
And I don't think they appreciated the ability, their own ability to do this, to do what's happened, right? So Sprott launched, we're talking about a differentiator between our index versus others. We have Sprott in ours. I fought tooth and nail with our compliance and legal people to make sure that Sprott was staying in, because we viewed, and you can go look at our social media where we have kind of tried to re-emphasize the importance of this Sprott event leading up to it. Again, I had no expectation of what was going to happen, and the immense demand for their fund. But if you looked at the mechanics and what it could potentially mean to a sector that has had no front month buying in its history, and if you actually believe that there was a big supply deficit and there wasn't a lot of mobile inventory out there, then how could you not think that this was potentially a watershed event? So Sprott and their entrance into the market, buying physical, has begun to make the market more efficient. And I think it's a shot across the bow of the utilities. There's sovereign wealth funds out there. There's this article on Friday that, probably spooked the market a little bit, but really what they were saying is that the Chinese need to build a strategic reserve. and they need to be able to source enough uranium to do that. And right now they're having a challenge. It's a challenge, and even Sprott is having challenges finding enough uranium out there. So it just reinforced this idea that there is not a sufficient amount of uranium available to end users to be able to be able to supply the market. And so, as markets do, it should be repriced, right? It needs to be repriced higher. And that's, if you go back and look at the video we have on our website, there's a supply deficit. It will be met with rising prices, and the price needed to double. Now the price has almost doubled from kind of when we started saying that, 25 to 50, it was 30 at the beginning of this year, low 30s. I still think prices need to go higher to bring on more production. But now you have this wild card with Sprott and the ability for financial speculators to come in and influence the market in a very meaningful way that hasn't existed. And so it's hard to kind of see exactly how it's going to play out, but the thesis has certainly accelerated a lot in the last month.
You probably know this, but we talked about it on a couple of shows ago. When gold came out, GLD, it's 15 years old. I thought it was older than that. Obviously came out, at virtually zero. It's at $58 billion, and that's just one gold, owning the physical metal ETF. So again, you could sort of say a half or 1% of that market is Sprott's for the taking. There's a precedent and a lot of upside for that. And what I understand, and maybe you could tell me, Sprott is not going to be selling it back to the utilities, from what I understand. Is that accurate?
Yes. Yeah. So there's an FT article that came out yesterday.
Okay.
Where John Champaglia basically said, and I think that was their effort to try and get out ahead of the market, saying that they're going to be sellers at some point.
Okay.
Is that the trust structure doesn't allow them to sell uranium. So that's not to say that people won't try and buy it from them. I do think that they can lend some of the uranium from their balance sheet, but the idea that they're going to be liquidating this thing to the utilities is just not accurate. But I do think that there is so again, one of the big drivers of the stocks the past couple of weeks was this announcement by Sprott that they were upsizing their at the market facility to $1.3 billion. So it's pretty remarkable. I mean, I think their silver trust is $4 billion, which they've raised in 18 months. Can they do that in uranium? I don't know. I don't know if there's enough uranium out there for them to do that. So it introduces this real wild card element. And it's hard to predict what's going to play out, whether or not there will be people who come in and try and stop them from doing what they're doing. I don't see anything wrong with it. Why is it any different than what's happening in silver or gold, except for maybe the utility function of uranium? Maybe you could make an argument that the utilities shouldn't have to compete with them, but it's a free market, right? People can speculate on oil. They can buy barges and ships of oil when the market's in contango. So why can't these guys go out and buy physical uranium? I don't know.
Well,
about it.
And this is either in your material or Sprott's materials. I think it's yours. At $35, we're talking about $6.3 billion. We use trillions to talk about what the government, throws around now. So I don't see why it couldn't just go into the rate base for the utilities if they have.
Yeah, no, it absolutely will. I mean, that's always been the argument about why higher uranium prices are much less. They don't destroy demand the same way that higher gas prices or higher oil prices do, because it's just not as significant a portion of the input cost for the utilities. I think what the utilities are frustrated about is, they think that this is not a real move, right? They don't think this is the actual price of uranium. So I think it's been such a violent move higher that the market just needs to digest. And if you're a utility fuel buyer, you're thinking you have months in order to secure fuel. If you're a sovereign wealth fund, again, the price was 30 earlier in mid-August. Now it's 50. So I just think things have moved so fast that people need to reorient themselves to the price. And then, ultimately, one of the big catalysts that we always talked about, and that I think it's in our materials, if it's not, we'll have to update that, but is that the utilities have been under contracting for the last 5 to 10 years, right? They've kind of been buying 30 to 50% of their needs. In the last cycle, one of the things that drove price was utility contracting, right? So they're entering into these multi-year contracts, generally 7 to 10 years. And those contracts they entered into a decade ago are now rolling off. And so you have this big waterfall of contracts expiring right as the time where a supply deficit is forming. And so those utilities need to go out and enter into contracts. And up until recently, there's been a stalemate because I think the utilities and a lot of other folks, for that matter, look at what was the price of uranium, where there was no front month buying to create price discovery. And they said, oh, well, there's plenty of uranium out there. Otherwise, the price would be moving higher, right? But it's just sitting at 30. So there must be plenty of uranium out there. We can take our time with contracting. And all of a sudden, that calculus has changed very quickly. But so we still haven't seen a meaningful contracting cycle. I guess it's possible that it won't happen, but I think ultimately as the utilities run out of uranium, they're going to want to enter into new contracts. And particularly with a price move like this, it will likely lead people to want to ensure that they have that security of supply.
What's happening with your flows, and what are assets under management now, please?
So we're about 700 million. Flows have been great. We've seen a lot of money come into the sector. I think Eric Balchunas from Bloomberg put out a tweet the other day saying about 400 million came in last week.
Saw that, yeah.
Yeah, so it's been fast and furious, and I think the last couple of days of we're just a little bit of shakeout of euphoria, and the thesis remains intact, right? The price of uranium still needs to probably move up, towards $65, $75, something like that, in order to really incentivize, restarts of Langer Heinrich, restarts of MacArthur River, and the Kazakhs bringing on more production. So you need those higher prices, and I think the producers, hopefully they remain disciplined. They've been very disciplined up until now, and I think that's certainly another wild card is that they decide to start selling more uranium into the market. But again, if you look at what Kazatomprom has said, they said they're going to remain disciplined. They're going to maintain their production cuts out to 2023. So until those types of messages change, I don't see how the thesis changes much.
What do you worry about? What is? I always like to know. I've got my own ideas, but the bull thesis is refuted by X. What's the most convincing thing you or Michael hear?
So there's two different issues. One is the bears, right? Particularly, there's a fund out there called Delbrook who's been getting quoted a lot. They were quoted in an S&P piece recently, where Mike was also quoted.
What's the name again, please?
Delbrook.
Okay.
Yeah. that this is a flash in the pan. This is the same as AMC and GameStop. And this is all Reddit, and there's, plenty of uranium out there. And there's plenty of uranium that out there, but not at economic prices for producers. So, there's always people who want to take the other side of the trade, particularly a trade that moves this fast. I think it's very rational to want to try and short it, because you just think it's just too far too fast. And as far as things, the real risks to this, one is some nuclear event, right? That's just the nature of the industry. And I can't remember the name of the plant, but there was a Chinese plant that had some issues with fuel rods earlier this year, and it spooked the sector pretty well. I think that was in June, and it just June or July, and it happened to align with Delta variant accelerating, and then kind of this move in the dollar, which knocked all commodities down. And so that's what took this, at least URNM, from kind of, I think, like the low 70s back down to about 50. Mm-hmm. And then Sprott launched and off to the races again. So I think it's naturally a very volatile sector, but in terms of big tail risks, it's always going to be that nuclear event that is also impossible to foresee.
Just a quick note: Japan's next Prime Minister, Taro Kono, apparently has talked about the need to restart nuclear plants to achieve carbon neutrality by 2050. And the old Prime Minister stepping down was the reason for the Japanese stocks perking up the other day, from what I understand. So that's just an aside that I had. Here's the long-term chart of Sprott. You mentioned 65, 75, but we went to 140 back in 07. And tell me what happened then that can't happen now.
There's no reason that it couldn't happen, particularly with the animal spirits and the amount of money that's floating around. I just, from a discipline perspective, and also just the fundamentals of supply demand, they need $65, $75 uranium.
Yeah.
Right. That doesn't mean that the market can't take it way past equilibrium. Right. Nothing tends to stop at equilibrium. Right. Markets are about fear and greed. And at 18, it was about as fearful as we're going to get. And that doesn't mean that we can't overshoot. So I just think from a disciplined fundamental value investor perspective, playing for that eventuality is not the most prudent thing. Everyone's got their own risk tolerance. So.
Yeah. Oh, the history of URNM trading at a premium or a discount to NAV. Where is it now, and how close does it track?
I'm gonna have to pull up the site. I don't always track it on a day-to-day basis. There's certainly been times like in around COVID where it traded to a discount. I think historically it's traded at a premium for most of the time. There is a nice chart on our website, actually, on the fund summary page. So yeah, I traded to a discount the other day, and it is also at a premium. But yeah, on average, it's been at a premium for most of its life.
Okay.
So there's a nice breakdown. So in 2020, it traded at a discount for 29 days. It traded at a premium for 223. And it's been about 15% of the time it's traded at a slight discount, and it tends to be, one day events like what we saw yesterday and Friday, where you have these big sell-offs.
This is my ooh la la segment, then I'll let you go. I might be too old. You might not know this song. It's the Faces, and I always like to go back, and I do all this for my sons, 24 and 23. Frankly, it's a blatant excuse to talk to them almost on a daily basis. But it stemmed from them firing questions and their friends joining in when they were in undergraduate business programs. And so here we are doing Bake Steaks. But what advice would you give to 23, 24-year-old Tim, please?
Oh, so many things. Definitely be more patient. I think I was incredibly impatient at that stage of my career. You know so little when you're coming out of college, and I think just try and learn as much as possible. If you can find a mentor, it's so valuable. I've been very fortunate that I had my older brother who was in the industry, and it's probably better because he wasn't hard on me. When I would do stupid things, like a professional mentor might have been. I think sometimes you gotta wait for your pitches, right? And if you really, again, everybody's mentality is very different. I've always been very entrepreneurial. I've always been very kind of risk seeking. For people who are not, find a job that you enjoy going to, that's intellectually stimulating, and the people that you like, and just grind, But if you're more entrepreneurial and you want to go out there and you want to try and build something, wait for the right time. And I don't mean that in the sense that there's going to be some, flashing light, but when you're 23, 24, work towards that, build a cushion, don't go into debt. Do the things that give you optionality, but don't get yourself in a position where your back is up against the wall. And when that opportunity comes, you're not prepared, right? And same thing in the markets, that's why using leverage is so dangerous, because it removes a ton of your optionality, because the time that you want to be buying, if you're really levered, you're having to delever. So to the extent that you can take excess money, and this is not like personal finance, like don't have coffee and don't go out to the bars with your buddies.
Right.
Do those things. Definitely do those things. Life is short. Take advantage of opportunities that, to do things with people you love. But if you're really passionate about being an entrepreneur or building something on your own, put yourself in a position financially to be able to take advantage when you do see that fat pitch, because that's, I missed a huge one earlier in my career, and who knows if it would have worked or not. But there was I met a guy, I was probably 25, and I met a team of guys, and they were really early on this secondary trading of Twitter and Facebook. And I could have literally created Facebook at $1 billion valuation.
Oh my God.
And so these guys, and so part of it is also having the confidence to do that, right? Why I left Merrill Lynch was that I didn't have the confidence that I could go out and build a book of business from CEOs and private equity guys at 23, which was probably the right decision. I don't think those guys would have spoken to me. But this one, I think if I had been in a better financial position to take a flyer, you
wouldn't be talking to me.
No, I wouldn't be talking to anybody. I'd be on an island somewhere. Because the opportunity, and if you looked also at when you get involved, I look at like this whole uranium thing, the number of people I've met and other opportunities and doors that's opened just as a function of being in an interesting place at the right time. It creates all these other avenues to do really cool things that you don't even think about. But so, I look at that, and I've got like a log of all of these things that I think I've missed, where I mentally told myself, this is a great opportunity. You need to do this. And a lot of people told me, that's a horrible idea. Like no one's going to buy Facebook stock from you in the secondary market. No one's going to buy Chegg and Twitter and Palantir and all these things. And it's like, you look at these companies now. So if you're in a position to take risks like that, sometimes they work, sometimes they don't, right? But at least you're there, and you can take the swing.
I know for a fact that I've sold some URNM, but because I get calls from people and texts and tweets all the time. It's wonderful. Tell me, our audience, how they can best follow you, reach you. What would you recommend?
Easiest place to follow us is at NS_indices on Twitter. We're pretty active on Twitter, also at URNM ETF. We try and put out, very relevant, timely articles that are about the sector. You can find all that information also at URNM ETF under the, I think it's news section. Yep, news and views is what it's called. And yeah, we just try and stay on top of the sector, and always happy to chat with folks. Ultimately, we're big bulls, but love talking about all investing. So happy to chat with folks.
Thrilled to meet you. Go Jumbos, and I will see you soon. Thanks so much.
Thanks, Biggs.
Bye now.
Bye-bye.